Is there like a framework? So one of the companies that I know because we were an investor in it and still have a little bit of public stock is Coinbase. And at one point, I think it was trading at like 1 times basically revenue plus their cash, right? So you look at something like that and you're like, man, maybe it could go down more, but like that sounds like a pretty good, multiple based on historical comps. Like, do you have some framework where you're like, okay, if a company that has a certain growth rate hits X, it's basically like a screaming buy opportunity and we look to deploy capital?
Well, the thing that's tricky about, I agree that by historical standards, certainly Coinbase now seems cheap. The hard thing about valuing a company like Coinbase is obviously it's totally derivative of what's happening in the crypto world.
Use a different company. Yeah.
So if there's like a crypto crash, it's like, well, then what's Coinbase? So, but like SaaS companies, for example, these are strong companies where you look at their amount of ARR. These are B2B subscription businesses. You want to look at their net dollar retention. Good for a public company usually starts around 120%. So on January 1st, they're typically starting with 120% of last year's revenue just from their existing customers. And then they're going to be stacking new cohorts on top of that due to new sales. We think those are very attractive businesses. They also tend to be more insulated in a recession because they're B2B, not B2C, and it's usually the consumer who gets impacted first in a recession. There's a number of like very fast-growing public SaaS companies that are doing $1 billion-ish in revenue, growing 40% year over year, at like 80% gross, 70-80% gross margins, really high gross margin businesses. These are like fun, with very strong franchises, big moats at this point. Those are, I think, attractive companies to own for the long term. Now, if you were in one of those stocks and it's gone down 80%, the hard part is it's going to take a long time for them to grow into their old valuations. If you can buy now, obviously the entry price is much more attractive.
Well, for founders, same exact problem, right? So, hey, if you went out and you raised money at a 35 times multiple, or
try 100 times,
or 100 times, or whatever the numbers were, and a lot of it's just undisciplined investing. Some of it was just, hey, I felt FOMO, I have a big fund, I have to deploy the capital. What do you do there if you're the founder who basically has this huge thing? I guess there's kind of two components. One is like, how do you ensure that your investors end up coming out on top, right? And do you just try to grow into the valuation as quickly as you can? And then two is like, how do you take care of the employees who now maybe their options are underwater or whatever on that? Like, how do you kind of mentor founders in that situation?
Yeah. So here's the good news if you're an early stage startup is if you're a public company, for example, and you're growing 20% year over year, and your value's gone down 80% because of this correction, you have to basically now grow 5x. What's that, like 500% to get back to where you were? Growing 20% a year, like that's going to take you forever. However, let's say that you are a startup that's tripling year over year, and there's like quite a few of those, right? You raised 100 times last year. Well, in just 1 year, it's going to be about 33 times, because you've now tripled your ARR. And the year after that, if you triple again, you're going to be at roughly 10 times ARR. And now you're starting to look pretty cheap. So it's much easier to grow into what was perhaps an inflated valuation last year as an early stage company that's roughly tripling or even say growing 2.5 times year over year. What you want to make sure of is that you give yourself the time, because where you don't want to be is needing to fundraise every 12 to 18 months like people were doing during the frothy times. You want to be in a position where you don't have to raise for 2.5, 3 years. And now you actually have the time to grow into your valuation. You won't get as big an up round as you thought you were going to, but you have the chance, if you grow 6 to 10 times over a 2-year period, to now get an up round.
I want to ask you a couple of scenario-based kind of just tactical things that I've heard founders ask me or talk about when I've been at dinners or kind of gatherings. The first is if you want to cut your burn, how do you evaluate cost? And if you center on, okay, I'm going to have to cut staff, like who do you cut? Do you cut your high salaries? Do you cut the people who you think are the least productive? Do you cut the people you don't like? What is the tactical way to actually evaluate, hey, I have to cut, my head count by 30%. Like, who do I cut?
Yeah, I think first of all, you have to figure out how much you need to cut. And one thing you need to do is ask the question, am I capable of fundraising in the current environment? Because fundraising right now is very tough, but not impossible if you have great metrics. In the presentation that you mentioned that we just sort of published, we have a slide that defines what good looks like, what great looks like, what good looks like, and then what bad, or we call it danger zone, looks like. And what we've said is, look, if you have all great metrics, there's like 5 main ones. It's your ARR growth rate, net dollar retention, CAC, capital efficiency, stuff like that. If it's all great, you're going to be able to raise. I would still be cautious how you spend, but it's not like, you're not going to be able to raise. If you're merely in the good column, you might have trouble. If you're great on 3 variables and good on 2, you'll probably be able to raise. If you have any danger zone variables, you probably will not be able to raise. So the first thing you have to do is assess, do you have any danger zones? Do you really think you're able to raise? And then the question is, so let's say that most startups have some problem they need to fix. Could be a gross margin problem, could be an excess burn problem, could be a growth problem. But if they're in the danger zone, you now know that I'm not going to be able to raise. When I run out of money, I'm dead. So I need to be able to make this money last long enough to fix my problems, to get out of the danger zone and into good to great metrics. So then the question is, well, how long do you need to do that? And in my experience, it takes, 2 years, minimum really, to fix big problems in a business. It's hard, right? Doing startups is hard. And you need to give yourself the luxury of time to fix those problems. The other thing you have to remember is, when you think about how much time you need, if you give yourself 2 years runway, you haven't, because you got to go out and fundraise 6 months, 9 months before you run out of money. So if you say I have 2 years of runway, you've really only given yourself 5, maybe 6 quarters to make effective changes in the business. And people want to see, VCs want to see that after you've made the changes that they're working. So this is why we say give yourself 2.5 years. So you have 2 years to work on the business, then you can go fundraise. And if you can give yourself 3, so much the better. You just don't know what market conditions are going to be like and you don't want your company to go out of business because of something that's happening in the macro, economic environment.
When you think about the founder who could raise, maybe they're in the good, maybe they're in the great, how much of this is like just go get the money and the economic kind of structure of the deal is less important than actually getting the money, versus you guys advise founders to still hold on to, do good fundraising deals, don't take down rounds, and kind of what is the weight of importance between money maybe versus terms of the deal at this point?
I think you want to get the money. You don't mess around, is my view on this. Look, I've always believed that the market sets the price, and it's better not to like monkey around with that. Don't try to do tricks or whatever. It's like, look, just run an efficient process, get all of your materials together, go out to enough firms, and then whatever the price is, that's the price. I mean, we're all price takers in this market. I mean, VCs are price takers too. People always think that somehow when I give this like bad news that I'm like talking my books and trying to drive down prices. I don't set the prices. What happens is a bunch of different firms proffer term sheets or not, and then it shakes out where it shakes out. And then founders hear from other founders who've gone through a process recently, and they hear, like prices aren't 100 times anymore. Like last year, they're 20 times, So word gets out, the price levels adjust. And so VCs, like our philosophy is we just choose the deals we want to be in, and then we try to pay the prevailing prices. And, last year prices were high, this year they're lower, but we just pay the prevailing prices. I would urge founders to have that mentality as well, which is, look, you're just out there raising this money because you need this money to survive and to grow your business. Like, making deals with VCs is not the point of your business. It's just something you do because you want to fund it. So go out there, raise the money you need, run a tight process, run a good process, and where the valuation shakes out, it shakes out. And by the way, if that means a down round, then so be it. I mean, look, I don't think there's a public company on earth, no matter how good, Amazon, Tesla, Microsoft, so forth, that hasn't had huge down days in the stock market. It hasn't all been one way up. But yet founders always think that, well, I've got to get like a huge up round. It's like sometimes the world doesn't work that way.
Yeah. A founder calls you and says, David, how do I run an efficient fundraising process in this environment? Is it get the materials in a data room, go out to 50 firms, just set up Zooms back to back to back and, see where term sheets come in, or is it something more complicated?
No, I think that's basically it. I mean, maybe not 50, maybe start with 10. But yeah, like get all of your materials together. It's, what questions you're going to get asked. what materials you're going to need. I don't understand why founders have fundraising conversations without getting all their materials together first. As long as they think, oh, it's not, well, I'm just having coffee with a VC or whatever. No, it's like, look, any conversation with a VC is a fundraising conversation. Sorry, that's the way it is. So get all your shit together.
We're not getting to know each other.
Well, that matters too, but it's still a fundraising conversation. Like, there's no point going out and having those conversations if you don't have your materials together. Mm-hmm. So get them together, create your data room, have all the metrics ready. Again, in the SaaS world, it's very obvious what you're going to be asked. And so if we start stumping you with questions that it just shows you're disorganized. So it's an easy way to put your best foot forward as a founder is just get all your stuff together. And then you probably are going to need to create a longer list than usual of firms to go talk to. Mm-hmm. And you can do it in waves. Sometimes you'll get some feedback on the first set of pitches you did, and then you can adjust your deck. Sometimes you'll hear the same concern over and over again. You might want to add a slide to address it.
Do you tell founders go to the best firms first, or maybe the firms that they're not as excited about getting, so they get the feedback and then go to the best firms?
Yeah, I think you just want to go to the list of firms that you think are the best fit for your business. And some of them are more prestigious names than others, but I wouldn't stress too much about that in this environment. Yeah. Just go to the VCs who've expressed the most interest in your type of business.
Mm-hmm. Another topic that is become way more popular than I ever thought it would is founder secondaries. And one, I guess, just like, what's your perspective from the investor seat, but also having built businesses, when founders should take secondaries, or when it's a red flag that they're taking secondaries, and kind of how to structure them. And then two is founders now who have taken secondaries have a pot of money, and most founders didn't have a pot of money before. Now they do. And they're asking themselves, like, am I a VC now? Should I just go angel invest in all my friends' companies? Should I just stick it in the S&P 500 and forget about it and go work on my company? Like, how do you advise founders there?
Yeah, so on founders taking secondaries, I think that the way secondaries started, way back when, is that you would have a company that was doing well, that maybe got an acquisition offer. And there was a feeling on the board, especially on the part of VCs, that this company could be much bigger if they just kept going. But the founder had all their eggs in one basket and would be very tempted to take this offer. And so creating partial liquidity for a founder was a great way to align everyone to go for the big long-term win. Mm-hmm. And so I'm very supportive of that idea. And, I've been a founder. I've had all my eggs in one basket. It's nice if you've earned the right to take some secondary because you've created a great business and you want to take a few chips off the table and then go for a bigger win.
Is that like 5% of your position, or like 50%? Like, how do you think about it?
50% would be way too much.
Okay.
I think what I've seen is founders taking a few percent, off the table, that kind of idea.
Okay.
If you see 50%, it's like, we'll just sell the whole company. I mean, that just, but I think what happened is that in the boom times, you started seeing secondaries become almost a matter of course because there was so much funding that was trying to get into companies. And look, I think it became acceptable as well in an environment in which companies were potentially overfunded and investors were trying to get to a certain ownership level that they're like, hey, can we buy some secondary from the founders? And I don't really have a problem with that either. But where I would, caution is in a much more difficult fundraising environment. It's irresponsible for founders to be seeking to take chips off the table when that money could be going into the corporate treasury. In other words, into primary in the company. And if there's any concern about the company not being adequately funded enough and the founders seeking to put money in their own pocket, that's a conflict of interest. Mm-hmm. And, it's not in keeping with their duty of loyalty to the company, put the company first. So I think in the current environment, a founder seeking to take chips off the table would be an incredibly negative signal and would probably sabotage your funding round. So I would not do that. If somehow you're one of the few companies in this environment in which people are literally throwing more money at you than you could possibly need, and you and the board decide together, like, look, this is more money than we need, mm-hmm. then maybe the founder could take chips off the table. But I wouldn't go seeking to do that in this environment.
Yeah, I think it makes complete sense. And then for those who either already have or are in the fortunate position where they've built such a great business that people are throwing money at them, what's been your advice to people in terms of, hey, you're a founder, you now have a pot of money, whether it's $1 million or more, bigger sums, put in S&P, angel invest, sit it in cash, give it to a fund manager? Like, what do you say?
Yeah, what I would say, so I think typically what makes sense for a lot of people like founders is to have a kind of a barbell strategy. So you've already got most of your net worth is tied up in the form of equity in this highly risky startup, let's say over here on the distribution. So the question is, what do you do with the rest of the money? And I think what probably makes sense is the barbell is you put that money in the safest thing possible, basically, because you already have so much exposure to market uncertainty and risk through the bulk of your net worth, which is in your company. And you want to avoid like excessive correlation to, like, let's say a depression or a recession or something like that. I mean, think about what would have happened. Let's say that you were a founder who did a big secondary last year, and you took all of that money and you put it in crypto, or you put it in the NASDAQ. Well, now you're down 50%, and you already had enough exposure to startup risk and sort of macroeconomic risk through your company. So I would advocate for a barbell strategy.